Hello everyone. Welcome to the course of International Macroeconomics. Today, we will learn Chapter 3, Exchange Rates 1, the monetary approach. In the long run, prices and exchange rates will always adjust so that the purchasing power of each currency remains comparable over baskets of goods in different countries. This hypothesis provides another key building block in the theory of how exchange rates are determined. In the last chapter, we learned how the spot exchange rate is determined. In this chapter, we look at the long run to see how the expected future exchange rate is determined. If investors are to make forecasts of future exchange rates, they need a theory of how exchange rates are determined in the long run. The theory we develop in this chapter has two parts. The first part involves the theory of purchasing power, which links the exchange rate to price levels in each country in the long run. In the second part of the chapter, we explore how price levels are related to the monetary conditions in each country, comparing the monetary theory of price level determination with the purchasing power theory of exchange rate determination. We emerge with a long-run theory known as the monetary approach to exchange rates. The goal of this chapter is to set out the long-run relationships between money, prices, and exchange rates. At first, we discuss exchange rates and prices in the long run, purchasing power parity, and goods market equilibrium. Just as arbitrage occurs in the international market for financial assets, it also occurs in the international market for goods. The result of goods market arbitrage is that the prices of goods in different countries, expressed in a common currency, tend to be equalized, applied to a single good. This idea is referred to as the law of one price. Applied to an entire basket of goods, it is called the theory of purchasing power parity. Our goal is to develop a simple yet useful theory based on an idealized world of frictionless trade, where transaction cost can be neglected. We start at the macroeconomic level with single goods and the law of one price. We then move to the macroeconomic level to consider baskets of goods and purchasing power parity. The law of one price states that in the absence of trade frictions and under conditions of free competition and price flexibility, identical goods sold in different locations must sell for the same price when prices are expressed in a common currency. By definition, in a market equilibrium, there are no arbitrage opportunities. If diamonds can be freely moved between New York and Amsterdam, both markets must offer the same price. We can mathematically state the law of one price as follows. For the case of any good G sold in two locations, using subscripts to indicate location and currencies, the relative price can be written. Relative price of good G in Europe versus US is equal to European price of good G in dollars over US price of good G in dollars. Relative price of good G in Europe versus US is equal to European prices of good G in dollar over US price of good G in dollars. When, PGUS is the worst price in the United States, PGEUR is the goods price in Europe, and E is the dollar-euro exchange rate used to convert euro prices into dollar prices. Relative price of good G in Europe versus US expresses the rate at which goods can be exchanged. It tells us how many units of the US good are needed to purchase one unit of the same good in Europe. E expresses the rate at which currency can be exchanged. We can rearrange the equation for the price equality. E times PGEUR equals to PEUS to show that if the law of one price holds, then the exchange rate must equal the ratio of the goods price expressed in the two currencies. The principle of purchasing power parity is the macroeconomic counterpart to the macro law of one price, we call LOOP. To express PPP algebraically, we can compute the relative price of the two baskets of goods in each location. Donated Q sub US over EUR. Relative price of baskets in Europe versus US is equal to European prices of basket expressed in dollars over US price of basket expressed in dollars. So relative price of basket in Europe versus US is equal to European prices of basket expressed in dollars over US prices of basket expressed in dollars. There is no upcharge when the basket of the same price in both locations. Q sub US over EUR is equal to 1. PPP holds when price level is in two countries are equal. When expressed in a common currency, this statement about equality of price levels is also called absolute PPP. The relative price of the basket is one of the most important variables in international macroeconomics, and it has a special name. It is known as the real exchange rate. The US real exchange rate Q sub US over EUR is equal to exchange rate dollars per euro times P sub EUR over P sub US. Tells us how many US baskets are needed to purchase one European basket. It is the price of the European basket in terms of the US basket. The exchange rate for currencies is a nominal concept. The real exchange rate is a real concept. It says how many US baskets can be exchanged for one European basket. The real exchange rate has some terminology similar to that used with the nominal exchange rate. If the real exchange rate rises, more home goods are needed in exchange for foreign goods. We say home has experienced a real depreciation. If the real exchange rate falls, fewer home goods are needed in exchange for foreign goods. We say home has experienced a real appreciation. Purchasing power parity states that the real exchange rate is equal to 1. If the real exchange rate Q is below 1 by X%, then foreign goods are relatively cheap, X% cheaper than home goods. In this case, the home currency, for example, the dollar, is said to be strong. The euro is weak. And we say the euro is undervalued by X%. If the real exchange rate Q is above 1 by X%, then foreign goods are relatively expensive, X% more expensive than home goods. In this case, the home currency, the dollar, is said to be weak. The euro is strong. And we say the euro is undervalued by X%. We can rearrange the non-upcharge equation for the equality of the price levels. E times PEUR is equal to PUS to allow us to solve for the exchange rate that would be implied by absolute PPP. So exchange rate is equal to the ratio of the price levels. Purchasing power parity implies that the exchange rate at which two currencies trade equals the relative price levels of the two countries. The PPP relationship between the price levels in two countries and the exchange rate is a key building block in our theory of how exchange rates are determined, as shown in figure 3.1. In this model, the price levels are treated as known as exogenous variables. The model uses these variables to predict the unknown endogenous variables. which is the exchange rate. The growth rate of the price levels is known as the rate of inflation or inflation. To consider changes over time, we introduce a subscript T to denote the time period and calculate the rate of change of both sides of the equation 3.1 from period T to period T plus 1. On the left-hand side, the rate of change of the exchange rate in home is the rate of exchange rate depreciation in home given by the equation. On the right of equation 3.1, the rate of change of the ratio of the two price levels equals the rate of the change of the numerator minus the rate of change of the denominator, where the terms in brackets are the inflation rate in each location, denoted pi US and pi EUR, respectively. If equation 3.1 holds for levels of exchange rates and prices, then it must also hold for rates of change in these levels. By comparing the last two expressions, we obtain relative PVP. Rate of depreciation of the nominal exchange rate is equal to inflation differential. This way of express PVP is called relative PVP, and it implies that the rate of depreciation of the nominal exchange rate equals the difference between the inflation rate of two countries. Economists have focused on a variety of reasons and why PVP fails in the short run. Transaction cost, including cost of transportation, tariff, duties, and other costs due to shipping and delays associated with developing distribution networks and satisfy legal and regulatory requirements in foreign markets. On average, there are more than 20% of the price of goods traded internationally. Non-traded goods. Some goods are inherently non-tradable. They have infinitely high transaction cost. Most goods and services fall somewhere between tradable and non-tradable. Imperfect competition and legal obstacles. Many goods are not simple, undifferentiated Many goods are not simple, undifferentiated commodities, as LOOP and PVP assume, but are indifferentiated products with brand names, copyrights, and legal protection. Such differentiated goods create conditions of imperfect competition because firms have some power to set the price of this good. With this kind of market power, firms can charge different prices, not just across brands, but also across countries. Price stickiness. Prices do not or cannot adjust quickly and flexibly to changes in market conditions.